what if I told you that one of the wildest, most opportunistic financial plays of this past quarter didn't actually come from a Silicon Valley tech giant?
Right, which is what everyone always assumes.
Yeah, exactly. And it didn't come from like a ruthlessly aggressive Wall Street hedge fund either. And it definitely didn't involve artificial intelligence or, launching rockets into low Earth orbit.
Not even close.
No. What if I told you that the company currently printing nearly $1 billion in just 6 months and aggressively hiking its dividend by like 15% is actually a boring local natural gas utility down in Texas?
I mean, it completely shatters the entire stereotype of the sector.
It really does.
Because the traditional utility model, it's designed from the ground up for stability, right? Not thrills.
Right. Slow and steady.
Exactly. The historical playbook is basically you dig a trench, you lay a pipe, you deliver the gas to a subdivision, and you collect a highly regulated, very modest return on your investment over like 30 to 40 years.
Yeah, which is the financial equivalent of watching paint dry.
It really is. And frankly, that's exactly why a certain class of investors, retirees, pension funds, endowment managers, why they love them.
Right, because they're supposed to provide that reliable, slow drip dividend in a chaotic world.
Exactly.
But then, you get a document like the one we're looking at today, and suddenly that slow drip stereotype just gets thrown completely out the window.
Thrown right out.
So, welcome to the deep dive. Today, our mission is to unpack the Q2 2026 earnings call transcript for Atmos Energy Corp.
And if you're looking them up, the ticker symbol is ATO.
Right, ATO. So we're taking a data-forward approach to translate all this dense, jargon-heavy Wall Street language from the call into, plain actionable insights.
Because there's a lot of jargon in this one.
Oh, heavily. We are going to look at the scoreboard, the physical steel in the ground driving those numbers, the massive regulatory shifts happening in the background, and finally, what it all means for an investor's portfolio.
Yeah, and setting the stage there is crucial. I mean, Atmos Energy is one of the nation's largest natural gas-only distributors.
Just gas.
Right, just gas. And the clues scattered throughout this transcript make their geographic center of gravity incredibly clear.
Which is Texas.
Exactly.
Yeah.
While they do have a regulatory and physical presence in states like, Kentucky, Tennessee, Virginia, their heart, soul, and primary growth engine are undeniably in Texas.
Yeah, and that includes their massive local distribution networks that hook up to everyday homes. But, more importantly for this discussion, it includes a massive piece of infrastructure called the Atmos Pipeline Texas.
Or APT for short.
Right, APT. And understanding the unique dynamics of the Texas energy market is really the only way to unlock the true story of this earnings call.
Because it's a very unique market.
Completely. So let's jump right into the numbers. They just reported nearly $1 billion in net income.
Which is staggering.
Yeah, $985 million to be exact in year-to-date fiscal 2026 net income.
Wow.
I mean, for a software company, that's a scaling victory built on code. But for a physical utility, you can't just invent that money out of thin air.
No, you have to have actual steel in the ground. Compressors running, millions of physical meters spinning on the sides of houses and factories.
Exactly. So what does that income look like when you distill it down to the individual shareholder level?
Well, the translation to the per share basis is what Wall Street really cares about, right?
Yeah.
So the earnings per share, the EPS, came in at $5.92 per diluted share for the first half of the year.
Okay, $5.92?
Yeah, and that represents a 12.5% increase over the prior year period.
Wait, 12.5%?
Exactly. For a regulated utility, reporting a double-digit EPS jump it's a massive red flashing light on a Bloomberg terminal.
Because it's supposed to be boring.
Right. It immediately signals to analysts that something outside the bounds of normal, slow and steady, predictable growth is happening under the hood.
And the management team, they aren't treating this as a fleeting anomaly either, right?
No, not at all.
They didn't just report a blowout quarter and stay quiet. They actively upgraded their expectations for the entire rest of the year.
Which is a bold move.
Yeah, they took their full year EPS guidance, which originally sat in a range of $8.15 to $8.35, and they bumped it all the way up to a new range of $8.40 to $8.50.
And raising guidance in the second quarter, that's a very specific type of financial posturing.
How so?
Well, the timing of that guidance raise is a crucial signal of corporate confidence. When a management team raises guidance only halfway through their fiscal year, they are essentially walking out onto the stage and telling the market that the tailwinds they're experiencing are deeply structural.
Like they aren't going away anytime soon.
Right. They're claiming they have pristine visibility into the back half of the year, enough to confidently plant their flag at a significantly higher elevation.
They're daring analysts to doubt their momentum.
Exactly.
But momentum in the utility space, it requires a staggering amount of upfront capital, right?
Oh, massive amounts.
Yeah, it takes a monumental amount of money to make that kind of money. The capital expenditures, the CapEx detailed in this call, are just heavy.
Yeah, they deployed $2 billion in just the first 6 months of the fiscal year.
$2 billion.
And CEO Kevin Akers noted they remain on track to spend roughly $4.2 billion in total for fiscal 2026.
That is a lot of pipe.
It is. But notice the allocation of that $4.2 billion. Akers specifically pointed out that over 89% of those investments are laser focused on enhancing the safety and reliability of their distribution, transmission, and underground storage systems.
So it isn't just about expansion.
Right. It's about fortifying the existing network. Because in the utility business, safety and reliability are your fundamental license to operate.
Yeah, if your pipes leak or your compressors fail during a winter storm, the regulators will freeze your ability to grow immediately.
Exactly.
That makes total sense. I mean, you have to maintain the roads before you can charge a toll on them. But, okay, here's the part of the transcript that genuinely made me pause and, reread the paragraph.
The dividend.
The dividend. They announced a roughly 15% dividend increase.
Which is wild.
It is. Now, I have to push back on this because it defies everything we just talked about regarding the, widow and orphan utility stereotype.
Yeah, it does.
A 15% dividend bump for a natural gas utility sounds almost reckless. Usually you see these companies bumping dividends by maybe 3, 4, or 5% a year.
Just to barely outpace inflation.
Exactly.
Yeah.
So is this 15% the permanent new normal for Atmos? Are they suddenly a hyper-growth dividend stock, or is there some kind of accounting trick happening in the background?
Well, your skepticism is entirely warranted. The short answer is no. This isn't a magical new permanent growth rate where they're going to hike it 15% every single year.
Okay.
It's tied to a one-time structural adjustment. During the Q&A portion of the earnings call, an analyst from Jefferies actually pressed them on this exact anomaly.
Because they saw it too.
Right. And management clarified that the dividend was, quote, rebased.
Okay, rebased. That is a classic piece of corporate jargon that sounds really impressive but tells me almost nothing.
Right. It sounds very fancy.
So if I'm an investor relying on that dividend to pay my mortgage or fund my retirement, what does rebasing actually mean for my wallet?
Think of it like taking a jackhammer to the foundation of a house, pouring a much thicker concrete slab, and then rebuilding the exact same house on top of it.
Okay, I'm following.
So Atmos has historically targeted growing their earnings per share at a very predictable rate of 6 to 8% annually.
Right.
And their financial policy is to grow the dividend commensurately with that EPS growth. So EPS goes up 6%, the dividend goes up 6%.
Good sense.
But because of a major regulatory change in Texas, something called Rule 77-102, which we will definitely unpack in extreme detail shortly, their overall underlying earnings power experienced a massive one-time step function jump.
Wait, let me make sure I'm following the logic here. So the pie suddenly got bigger.
Right.
But it didn't get bigger just because they pumped more gas through the pipes. It got bigger because the bureaucratic rules of how they are legally allowed to account for their massive infrastructure investments changed in their favor.
Exactly. The regulatory shift allowed them to recognize their earnings much more efficiently.
Wow.
The drag on their profitability was suddenly lifted. So because the base foundation of their earnings jumped up so drastically, the board of directors looked at the cash flow and decided to rebase the dividend up by 15% to match that new higher earnings reality.
So it's a recalibration.
A permanent recalibration. Moving forward, as management explicitly confirmed on the call, investors should not expect 15% hikes every year.
So no 15% next year?
No. The growth rate will converge back to their historical 6 to 8% trend line. However, and this is the key part, that future 6 to 8% growth will now be calculated off this new, significantly higher baseline.
Okay, I think I've got it. It's exactly like getting a sudden 20% promotion at your corporate job.
Yes.
Your lifestyle and your spending might take a big one-time jump to match your new salary bracket. But from then on, you go back to getting your standard, boring 3% annual cost of living raises.
Right.
It's just that those 3% raises are now building off a much higher base salary.
The promotion analogy hits the nail on the head.
Yeah.
And what it demonstrates to Wall Street is that management is deeply committed to shareholder return.
Which is what you want to see.
Absolutely. When the regulatory environment handed them a massive financial win, they didn't just hoard the cash in the corporate treasury or waste it on an ill-advised acquisition.
Right.
They immediately formulated a plan to pass the benefits directly through to the shareholders.
So we have the scoreboard. Massive net income, guidance raised mid-year, $4 billion in heavy capital spending, and a permanently rebased, much higher dividend.
A very strong scoreboard.
Yeah, but to really understand a physical business, you have to look past the spreadsheet and look at the dirt.
The operations, right?
Exactly. What physical realities actually changed this quarter to generate that kind of cash? I mean, how do you actually grow a utilities footprint in a way that supports $1 billion in 6-month net income?
Well, the most fundamental driver for any utility is population dynamics.
People moving.
Right. It is simply a function of how many new meters they are installing on the sides of buildings. Customer and infrastructure growth are the absolute bedrock of their valuation.
And the transcript notes that in the 12 months ending March 31st, 2026, Atmos added over 51,000 new customers to their system.
Which is huge.
51,000 new meters in a single year. To put that in perspective, that is roughly the entire population of a mid-sized American suburb just bolted onto their existing infrastructure in 12 months.
And the geographic breakdown of those new customers is incredibly telling. Over 39,000 of those new connections are located right in Texas.
Which is just a perfect hard data illustration of the macro demographic trend we see constantly in the financial press, right? People and corporations are flocking to Texas at an unprecedented rate.
Yes, they are. And the influx isn't just residential subdivisions either. No, the CEO made a point to highlight their commercial and industrial wins. During the second quarter alone, they added over 800 commercial customers.
Wow.
And 4 new industrial customers.
Okay, now, to a layperson, adding 4 industrial customers might sound like a rounding error compared to 50,000 residential houses.
They might sound small, yeah.
But in the utility sector, hooking up an industrial customer is a massive needle-moving event, isn't it?
Oh, it changes the entire demand profile of a local grid.
How so?
Because one industrial customer, let's say it's a new automotive manufacturing plant, or a massive data center with localized power needs, or a large chemical processing facility, they can consume as much natural gas in a single week as an entire residential neighborhood consumes in a year.
Just massive volume.
Exactly. Furthermore, industrial demand is consistent. A homeowner only turns on the furnace when it's cold. But an industrial plant runs its boilers and turbines 24 hours a day, 7 days a week, 365 days a year.
So they provide massive, predictable baseload demand.
Yes, but to service that kind of explosive, heavy-duty growth, particularly in booming areas like the Dallas-Fort Worth Metroplex, you can't just run a standard plastic pipe under a sidewalk.
No, you need monumental infrastructure.
Exactly.
Which brings us to a specific engineering feat mentioned in the call, the Line WA project.
Right, Line WA.
The transcript notes they just completed phase 2 of this project during the second quarter. They installed approximately 44 miles of 36-inch pipeline to the west of Fort Worth.
That's a massive project.
I really want to pause on the physical reality of this for a second. 36 inches, that is a pipe 3 feet in diameter. You could practically crawl through it. We aren't talking about the little yellow lines they bury when they build a new cul-de-sac.
No, a 36-inch pipeline is massive transmission infrastructure. It requires specialized heavy machinery, massive right-of-way acquisitions, environmental permitting, and highly skilled welding crews.
That's a massive undertaking.
They are building the major arterial highways needed to move massive high-pressure volumes of gas into regions experiencing explosive growth. Fort Worth is expanding rapidly westward, and Atmos is essentially building the invisible civic infrastructure required to make that geographic expansion possible.
It's a prime example of why their CapEx budget sits at $4.2 billion. You do not build 44 miles of 3-foot wide steel pipe cheaply.
You definitely don't.
Okay, so the physical expansion story makes perfect sense. They're building massive pipes to service a booming Texas population.
Right.
But there's another profit driver mentioned in this call that seems completely disconnected from hooking up new houses.
Yeah, the Waha dynamic.
Yeah, it sounds less about physical growth and more about, like, wild market timing.
This is where we have to talk about the Waha pricing dynamic.
That's fascinating. The CFO, Chris Forsyth, mentioned that the APT, the Atmos Pipeline Texas Through System business, added $16 million, or 8 cents per share, period over period.
Right.
And he explicitly tied this windfall to something called Waha spreads.
And this Waha discussion is where the transcript gets highly technical, but it is the secret engine of their outperformance this quarter.
So explain this secret engine.
Let's break down the physical geography and the market mechanics. The Waha hub is a major natural gas pricing point located out in the Permian Basin in West Texas.
Okay. And for those unfamiliar, the Permian Basin is one of the most prolific oil-producing regions on the entire planet.
Exactly.
Right. But Atmos is a natural gas distributor. They don't drill for oil. Why do they care about an oil patch in West Texas?
Because of physics. When exploration and production companies drill wells in the Permian to extract highly valuable crude oil, massive amounts of natural gas come up out of the wellbore right alongside it.
Oh, I see.
In the industry, this is known as associated gas. The drillers are primarily focused on the oil because that's where the massive global profit margins are. The associated natural gas is almost treated like an annoying byproduct.
What's getting in the way of the oil?
Exactly.
Yeah.
And because oil production is so high right now, unbelievable volumes of this associated gas are being pulled out of the ground, creating an enormous localized supply glut right at the Waha hub.
Okay. And Economics 101 says that when you have a massive oversupply of a commodity in one specific location, the price of that commodity is going to crash.
The price doesn't just crash, it completely breaks the traditional models. But here's the catch. The gas has to get out of West Texas.
Right. It can't just sit there.
It needs to travel to where the actual demand is. Places like the DFW Metroplex to run power plants, or down to the Gulf Coast to be liquefied and exported to Europe or Asia.
And the only way to move it is through those high-pressure transmission pipelines we were talking about.
Exactly. And currently, the Permian Basin suffers from severe constrained takeaway capacity. There simply aren't enough physical pipelines built yet to move all this byproduct gas out of the basin as fast as the oil drillers are pulling it out of the ground. It creates a monumental physical bottleneck.
Okay, let me try an analogy to see if I'm grasping the financial mechanics of this bottleneck.
Go for it.
Imagine a massive concert, maybe like a Taylor Swift show, is letting out at a massive stadium.
Okay.
Tens of thousands of people are all pouring out of the exits trying to leave at the exact same time. That crowd is the associated gas pouring out of the Permian oil wells.
Right.
But there is only one tiny 2-lane road leading away from the stadium back to the city. That road is the constrained takeaway capacity.
The setup is perfect.
Yeah.
Now, what happens on a rideshare app when 50,000 people want a car, but there aren't enough roads or drivers to handle the volume?
The algorithm triggers surge pricing. A ride that normally costs $20 suddenly costs $150. The cost to get out of the bottleneck skyrockets.
And in the natural gas transmission market, that surge pricing is referred to as a spread.
Ah.
Because the gas is physically trapped in West Texas with nowhere to go, the price at the Waha hub drops to extreme lows. In fact, it drops so low, the prices sometimes go negative.
Wait, negative?
Yes. Drillers will literally pay pipeline operators to take the gas away.
Yeah.
Because if they can't get rid of the gas, regulators will force them to shut down their highly profitable oil wells.
Oh, wow. So they have to move it.
They have to. Meanwhile, the price of gas on the other end of the pipe in Dallas or Houston remains at a normal, much higher market rate.
So the financial difference between that dirt cheap or even negative West Texas price and the higher destination price, that's the spread.
That is the spread.
And Atmos owns the highway.
Exactly.
Because Atmos Pipeline Texas has existing physical space on its pipes to move gas from the Permian bottleneck to the rest of the state, they get to capture that massive difference.
They buy the gas at Waha for pennies or literally get paid to take it, move it through their massive 36-inch pipes, and sell it where prices are higher.
They are effectively surge pricing the commodity.
The data backs up that surge pricing theory perfectly, too. Look at the specific numbers CFO Chris Forsyth shared on the call. During the first 6 months of fiscal 26, the spreads Atmos captured averaged $4.35.
$4.35.
Compare that to just $1.80 in the prior year period.
That is an explosive, anomalous increase in their profit margin.
It really is. And management explicitly cited 3 distinct drivers for this wild quarter: rising associated gas production from the oil drillers, the severe pipeline bottlenecks keeping the gas trapped, and crucially, lower overall demand due to an unseasonably warm winter.
Wait, how does a warm winter help them make more money? Usually, utilities want freezing weather so people turn their heaters on.
Normally, yes, you're exactly right. But in this specific bottleneck scenario, a warm winter means there is very little local heating demand in West Texas to soak up any of that excess gas.
Oh, I see.
So the localized oversupply becomes even more extreme, driving the Waha price even lower, which makes the spread the difference between Waha and the rest of the country even wider.
So the weather actually exacerbated the bottleneck.
Exact.
That is genuinely wild. I mean, it's like they are operating a private toll road where they have the legal right to dynamically increase the toll by 300% just because the state highways are jammed.
It's incredibly opportunistic profit.
But as an investor looking at a long-term hold, it also sounds like a very dangerous metric to rely on. Surge pricing only lasts until the crowd disperses or a new road is built.
The Waha spread is a tremendous windfall, but you're identifying the core risk here. It is a highly volatile, unpredictable revenue stream that cannot be modeled with any certainty over a 10-year horizon.
Which actually highlights another really interesting little nugget buried in the transcript before we move on to the state regulation.
Oh, the tariff.
Yeah. Because Atmos has been capturing these massive opportunistic spreads and optimizing the pipeline, they haven't just been padding their bottom line, they've actually been forced to give a chunk of that money back to the public.
Right.
The CEO mentioned that over the last 3 years, customers have received approximately $150 million in total as a credit on their bills from something called the Rider-Rev tariff.
And the Rider-Rev tariff is an essential piece of the regulatory puzzle that keeps the whole system balanced.
How does it work?
Well, while Atmos captures these wild opportunistic spreads on their transmission system, the regulatory framework in Texas requires them to share a calculated portion of those windfall profits with their regular residential distribution customers to help lower their monthly heating bills.
So it's like a political and financial mechanism designed to ensure that the utility doesn't just hoard all the benefits of market volatility.
Exactly. It uses that corporate windfall to directly offset the living costs for everyday ratepayers.
That is fascinating. It's a pressure release valve for public relations. If the utility is making $1 billion off surge pricing gas, the regulators ensure the grandmother in Dallas sees a $50 credit on her winter heating bill.
Right. It keeps the regulators happy, the public quiet, and the utility profitable.
Which is the perfect transition, really. We've seen how the physical steel in the ground and the Wild West Texas commodity bottlenecks fueled this specific quarter.
Right.
But if you read between the lines, the biggest long-term driver mentioned in this entire transcript isn't a pipeline at all.
No, it's a change in the bureaucratic rulebook.
The state of Texas essentially changed the laws of financial physics for Atmos. So let's dive into the regulatory engine and specifically demystify Texas Rule 77102.
If an investor wants to understand why Atmos' stock is behaving with such structural strength, they have to understand the mechanics of this specific rule.
Okay, lay it out for us.
It stems from a piece of legislation called Texas House Bill 4384, which the Texas Railroad Commission recently finalized into Rule 77102.
And just as a quick aside, the Texas Railroad Commission is a historical quirk, right? They don't regulate railroads anymore?
Correct. They are the primary regulators of the oil and natural gas industry in the state.
Good to know.
So to understand why this new rule is such a monumental victory for Atmos, we first have to thoroughly understand a painful financial concept called regulatory lag.
Oh, regulatory lag. That is a phrase I hear constantly in utility analysis, and it always makes my eyes glaze over.
It sounds super boring, I know.
It sounds like an excuse management teams use when they miss their earnings targets. Walk me through the actual mechanics of regulatory lag.
To grasp it, Step outside the utility world for a second and imagine you are a large-scale real estate investor.
I'm a real estate investor.
You buy a massive, dilapidated apartment complex. You spend $10 million completely renovating the units, putting in new plumbing, new roofs, new appliances.
That was expensive.
Very. But the local city council tells you that you are legally forbidden from collecting a single dime of rent from any new tenants until the city inspector comes out, reviews every single one of your construction receipts, audits your labor costs, and officially passes a city ordinance approving your renovations.
And I'm guessing that takes a while.
Try 18 months.
So for a year and a half, I am out $10 million in cash. I am paying massive interest on the bank loan I took out to finance the construction.
Yep.
I am paying property taxes on the newly renovated higher value building. And I have zero rental income coming in to offset any of those carrying costs.
None.
That sounds financially agonizing. It would absolutely destroy my quarterly cash flow.
That agonizing cash burning waiting period is exactly what regulatory lag is for a public utility.
Oh, okay.
Atmos spends billions of dollars building those massive 36-inch pipelines and hooking up new subdivisions.
Right.
But under traditional regulatory frameworks, they cannot just automatically start charging customers on their monthly bills for those specific new pipes.
They have to wait for the inspector.
They have to file a formal rate case with the state regulators. The regulators scrutinize the spending to ensure the utility isn't overcharging the public, which is a process that can take months or even years to resolve.
Wow.
And during that lag, the utility has to eat all the carrying costs. The interest on the corporate debt used to build the pipe, the physical depreciation of the asset as it sits in the ground, and the local ad valorem property taxes.
Okay, the pain point is incredibly clear. Enter Rule 77-102. How does this new Texas rule alter the reality of that real estate analogy?
The new rule doesn't eliminate the inspection process, but it significantly changes how the utility is allowed to account for the financial pain of the waiting period.
Okay.
The rule permits gas utilities in Texas to defer post-in-service carrying costs, depreciation, and ad valorem taxes associated with certain capital investments, specifically targeting investments made for new customer growth and system expansion.
Wait, let me stop you there. Defer just sounds like kicking the can down the road.
It does sound like that.
If I am the real estate investor, deferring my costs doesn't mean cash is magically appearing in my bank account today to pay the bank. How does deferring an expense actually help Atmos's start price right now?
It comes down to the psychology and mechanics of Wall Street accounting.
Okay, explain that.
Instead of those massive carrying costs immediately hitting Atmos's income statement and severely dragging down their reported quarterly profits while they wait for the rate case,
Right.
the state allows them to set those costs aside in a special regulatory asset bucket on their balance sheet.
Oh, interesting.
They essentially get a legally binding IOU from the Texas government saying, we acknowledge you incurred these costs to build necessary infrastructure, and we promise you will be legally allowed to collect them from ratepayers in the future.
Wow, okay. So by deferring the expense today, their currently reported earnings look much healthier and accurately reflect the long-term value of the asset rather than being temporarily depressed by a bureaucratic waiting period.
Exactly. It completely changes the picture.
Okay. So it doesn't mean a truck full of cash is pulling up to their headquarters today.
No cash today.
But it completely changes how a Wall Street analyst models their profitability.
100%.
Because those massive upfront costs aren't dragging down the quarterly numbers anymore, the company looks significantly more profitable on paper during the heavy construction phase.
Right.
And the financial impact they cited on the call is huge. CFO Chris Forsyth estimated the impact of this rule will range from $155 million to $165 million pre-tax for the entire fiscal year.
And the sheer scale of that number is exactly why it triggered the dividend rebasing we talked about earlier.
That makes perfect sense now.
During the Q&A, an analyst from Wolf Research specifically asked for clarity on the long-term mechanics of this 155 to 165 million figure.
Right.
Forsyth explained that this is a rebasing year. Because the rule was finally codified into law, Atmos now has pristine, legally backed visibility into how they will account for the billions of dollars they are spending in Texas.
Now, if I'm trying to deduce why the Texas Railroad Commission is being so generous here, I have to look at the macro context. Texas regulators aren't known for just handing out favors to corporations without a reason.
Definitely not.
They have a massive incentive to make sure this infrastructure gets built, right?
Oh, huge.
If we look at recent history, grid failures, massive winter storms causing catastrophic power outages, The state is desperate for reliable energy infrastructure.
Absolutely desperate.
So by passing Rule 77-102, the government is essentially removing the financial friction for Atmos. They are saying, please build as many pipes as fast as you can to keep the state running, and we will tweak the accounting rules so Wall Street doesn't punish your stock price while you do it.
The political and economic incentives align perfectly. It is a highly symbiotic relationship.
Yeah, it really is.
Texas desperately needs the physical pipes to keep their explosive economic engine running and to prevent grid failures.
Yeah.
Atmos has the engineering capability to build them, but they need the rule change to keep their cost of capital low and their shareholders happy while they deploy billions of dollars.
But implementing a new accounting rule is always messy. The transcript mentions a very specific accounting shift that happened this quarter as a direct result of finalizing this rule. They noted that it reduced reported O&M operations and maintenance expenses for the first 6 months by $41 million.
Right, that $41 million.
And then there was this incredibly dense, highly technical exchange during the Q&A where an analyst from Jefferies asked to confirm if this $41 million was just a one-for-one change and not a net earnings change.
Yeah, that got deep into the weeds.
So let me be the skeptic here. If an investor is ultimately just looking at the bottom line net income, why should they care about an internal accounting reclassification that just moves money from one bucket on a spreadsheet to another?
Right.
If the total amount of money didn't change, why did the analysts care so much?
Because Wall Street analysts do not just look at the bottom line. They build intricate discounted cash flow, or DCF, models based on specific line items. The placement of the expense dictates how they project the future. Originally, before Rule 77-102 was totally finalized, Atmos was taking a conservative approach and dumping all of these deferred costs into the general interest expense line item.
Just putting it all under interest.
Exactly. But once the final rulemaking was published by the state, they realized that wasn't legally or financially accurate. The deferred costs weren't just interest. They were a complex mix of O&M, property taxes, and interest.
Oh, I see.
So they went back into the ledger and reclassified that $41 million out of interest and put it back into the specific line items where it historically belonged.
So they essentially just sorted the corporate laundry into the correct baskets.
That's a good way to put it.
But if I am building a financial model, why does a bloated O&M basket scare me more than a bloated interest basket?
If a company's O&M looks artificially high, an analyst might incorrectly assume the core business is deteriorating.
Like they're losing control of costs.
Right. They might assume management is operating inefficiently, perhaps overhiring, failing to control labor costs, or dealing with an aging, leaky system that requires constant expensive repairs.
Oh, I see.
By reclassifying that $41 million correctly, management strips away the noise and gives investors a pristine look at the actual operations. It proves that their core business is running incredibly efficiently.
It is about transparency and predictability.
Exactly. It proved to the market that the regulatory engine in Texas is functioning exactly as intended to protect the massive capital Atmos is deploying without masking operational inefficiencies.
Wow. It really is a masterclass in controlling the corporate narrative through precise accounting.
It's brilliant.
Okay, so we understand the past and the present. We know why the numbers are up. We know the pipes are in the ground. And we understand the state rule book protecting the investment.
Right.
Now, we have to pivot to the future. What did management tell Wall Street to expect for the rest of 2026 and into 2027?
Let's start with the APT, the Atmos Pipeline Texas performance. They've had this incredible, highly opportunistic run with the Waha spreads.
Yeah, that massive surge pricing. Do they expect the surge pricing to continue forever?
Well, management is adopting a highly cautious tone regarding the future of the Waha spread, which is exactly the kind of sober leadership you want to see.
Right, you don't want them promising the moon.
CFO Chris Forsyth stated they expect the APT through system business to add another 8 to 12 cents to earnings per share in the second half of fiscal 26.
Okay, so that is still a very nice accretive bump to the bottom line, but he also threw in some very deliberate cautionary language, didn't he?
He did. He specifically noted they anticipate Waha pricing to remain, quote, challenging, and they are actively waiting to see how the summer power generation load in Texas affects the broader market.
So what exactly does a utility executive mean when they call a market challenging? Because from where I'm sitting, a chaotic, bottlenecked Waha market has been wildly, obscenely profitable for them.
It has.
Challenge seems to equal cash.
In the lexicon of utility executives, challenging is a polite synonym for highly unpredictable.
Oh.
Atmos builds their long-term financial models and their initial yearly guidance based on benchmark historical norms. They do not build their corporate budget, assuming they will receive massive windfall profits from a fundamentally broken commodity market.
Right.
And right now, the Waha hub is broken. There's too much gas and not enough physical pipes.
But Atmos isn't the only company that sees this opportunity.
Exactly. New takeaway pipelines are constantly being planned, permitted, and built by massive competitors like Energy Transfer or Kinder Morgan.
So the bottleneck won't last.
If a competitor suddenly brings a massive new 42-inch takeaway pipeline online, that bottleneck instantly relieves itself.
Wow.
Or if the macro weather normalizes and demand shifts, that beautiful $4.35 spread could vanish overnight, reverting violently back to the historical benchmark of $1.80 or even lower.
It goes right back to the stadium analogy.
Yeah.
If the city suddenly opens a brand new 4-lane superhighway right next to the stadium exits, the crowd disperses in 10 minutes and the Uber surge pricing immediately disappears.
The algorithm resets to baseline.
Right. Atmos knows they cannot rely on the Waha spread to fund their long-term dividend.
And the executive team is acutely aware of this transient reality. When an analyst pressed them during the Q&A on what their specific projections were for Waha spreads in 2027, CEO Kevin Akers basically refused to take the bait.
What did he say?
He flatly stated they don't have a crystal ball.
Honest, at least.
He noted they need to see how the intense Texas summer heat, which drives massive, prolonged natural gas demand as power plants burn gas to run millions of residential air conditioners, actually impacts the physical flow of the market before they make any promises to Wall Street about next year's margins.
Which perfectly illustrates why the boring, bureaucratic regulatory rate cases are the actual lifeblood of the company.
Exactly. The Waha spread is the lottery ticket. The rate case is the paycheck.
The paycheck. I like that. The transcript notes they have already successfully implemented $136 million in annualized operating income increases across their various distribution segments.
And they highlighted a major upcoming catalyst for the pipeline segment, too. APT's grid filing, seeking $112 million, which was scheduled for a May 12th hearing with the Texas Railroad Commission.
So that $112 million regulatory filing is the absolute bread and butter of utility growth.
It is. This is the culmination of the process we discussed earlier. They have already spent the capital, they have laid the 36-inch pipe in the dirt, the gas is flowing, and now they're going through the formal legal process to permanently add that massive asset to their approved rate base.
Now, once approved, this provides the predictable, ironclad cash flow that replaces the volatile, transient Waha spread money.
Exactly.
All right, let's transition to the balance sheet and their overall liquidity profile, because this section of the earnings call really stood out to me as a masterclass in corporate financial strategy and risk management.
It's very impressive.
They detailed a rock-solid equity capitalization ratio at 61%, and they boast $4.1 billion in total available liquidity.
Which is a massive war chest.
It is. But the genuinely fascinating part of the strategy was their discussion of their ATM equity program.
Right, the ATM.
For those listening, ATM stands for at the market. It is a mechanism companies use to slowly, quietly sell new shares of stock directly into the open market to raise cash for massive construction projects.
And management explicitly noted they didn't price any new equity in the second quarter.
None. Now, I have to push back and deduce the strategy here. The broader stock market, generally speaking, was hitting all-time highs during this period.
They what?
Their own earnings were absolutely fantastic, driven by the Waha spread and customer growth. Usually when times are good and your stock looks highly attractive to investors, management teams love to hit the ATM button, sell shares at a premium, and raise cheap cash.
That's the conventional playbook.
So why hit pause? Why not sell shares when everything looks great and the market is buying?
It is a brilliant question, and it speaks to the high-level sophistication of their corporate treasury team.
Okay, break it down.
Yes, conventional wisdom dictates that raising money when your stock price is high is generally a smart move. But a sophisticated treasury team doesn't just look at their own stock price. They look at the macro volatility environment.
Okay.
During the Q&A, an analyst asked them to justify this exact decision. Management pointed out that while the market was generally up, the second quarter was actually marked by intense, violent volatility driven by unpredictable geopolitical events and rapidly shifting economic news regarding inflation prints and the Federal Reserve's interest rate decisions.
Right. The market was incredibly jittery. One day the Fed is cutting rates, the next day inflation is hot and they are holding steady. Meanwhile, overseas conflicts are threatening global supply chains.
Exactly. If you are the CFO of a utility, you fundamentally despise volatility.
Because they're supposed to be boring.
Right. When the broader market is violently swinging up and down based on a central bank press conference, it is a terrible time to try and price a massive block of new shares.
That makes sense.
You might get caught on a sudden irrational downswing and end up diluting your existing shareholders unnecessarily because you sold shares too cheaply.
But they had a massive safety net in place that allowed them to be patient, right?
They did.
The transcript mentions they currently have roughly $890 million available in something called forward sale agreements.
Yeah, the forward sale agreements are key.
Let's demystify that term. What is a forward sale agreement and how does it act as a safety net?
A forward sale agreement is essentially a financial time machine.
A time machine.
It means that at some point in the past, when market conditions were calm and favorable, Atmos locked in a legally binding contract with an investment bank to sell a specific number of shares at a guaranteed price.
Okay.
But, and this is the key, they haven't actually triggered the transaction to take the cash yet. It is like having a massive pre-approved line of credit at a guaranteed locked-in stock price.
Oh, that's brilliant.
Because they already had this massive $890 million safety net locked and loaded, which comfortably covers their anticipated capital needs for the rest of fiscal 26 and even part of 27.
Yeah.
They didn't need to brave the unpredictable, volatile open market in Q2.
Management actually used the specific phrase, keeping our powder dry.
Exactly.
They had the absolute luxury of stepping back, watching the geopolitical and macroeconomic chaos unfold from the safety of the sidelines, and saying to themselves, we don't need to play in this traffic right now. We have guaranteed cash waiting for us whenever we want to push the button.
It is an incredibly strong position of leverage to be in. It projects a deep, calm confidence to Wall Street analysts who are desperately looking for stability.
And that projection of calm structural confidence extends far beyond the financial engineering. It extends directly to their operational metrics as well.
Oh, absolutely.
While we have spent a lot of time deep in the financial and regulatory weeds, it is vital to note the operational context management provided to wrap up the call.
Yeah, they brought up some interesting softer metrics.
They specifically highlighted a 97% customer satisfaction rating for the first 6 months.
97% is huge for a utility.
It really is. They also noted that their customer advocacy team actively helped 33,000 low-income customers receive $9.5 million in funding assistance to pay their heating bills.
Which is great, but it's a fascinating detail to include in an earnings transcript.
Why do you say that?
Well, why does the CEO of a multi-billion-dollar corporation take up valuable time on a call with ruthless Wall Street analysts, people who typically only care about EPS, DCF models, and dividend yields, to talk about funding assistance and customer satisfaction surveys?
Right. Why bother?
Because in the highly regulated utility sector, public perception is regulatory reality.
That's a great phrase.
If your customer base actively hates you, if you are constantly shutting off power to vulnerable populations, or if your customer service lines are jammed with angry ratepayers, local politicians will notice.
And the politicians run the regulator.
Exactly. And those local politicians appoint the regulators.
Right.
If the public hates you, the regulators will make your life absolute misery every single time you file a rate case asking for more money.
Ah, so it's defensive.
By proving to Wall Street that they have a 97% satisfaction rate and are proactively helping struggling customers manage their bills, they're demonstrating that their relationship with the community, and by direct extension, the political and regulatory apparatus, is healthy and stable.
It massively de-risks the stock from political intervention.
Precisely. Furthermore, management mentioned being named to the Forbes list of America's best large employers for the 6th consecutive year.
Ranking second among all utilities nationwide.
Right. And in a persistently tight industrial labor market, where retaining highly skilled welders and specialized technicians to lay 36-inch pipes safely is a critical bottleneck, that premier employer branding is not just a vanity metric.
It's an operational necessity.
It is a tangible operational competitive advantage.
It is the application of soft power to enable the hard financial numbers.
Exactly.
If the workers want to work there, the pipes get built. If the customers are happy, the regulators approve the rate cases. If the rate cases are approved, the dividend goes up.
It is a complete functioning ecosystem.
Okay, we have thoroughly covered The financial scoreboard, the physical pipes moving the gas, the regulatory rulebook protecting the capital, and the high-level treasury strategy navigating the equity markets.
We covered a lot of ground.
Now it is time to bring it all together. This brings us to our final synthesis.
The bottom line.
If someone is listening to this deep dive, trying to build a thesis, and trying to decide if the signals buried in these pages are fundamentally bullish or bearish for the long-term prospects of the stock, what is the ultimate verdict? Let's weigh the evidence.
Well, the evidence on the bullish side of the ledger is overwhelmingly strong, almost structural in nature.
Start with the biggest bullish signal.
The most critical, undeniable takeaway is the rebasing concept.
The new baseline.
Right. Management did not just report a lucky weather-driven quarter, they structurally, permanently elevated the financial foundation of the entire company.
The upgraded $8.40 to $8.50 EPS guidance is the new floor, the new launchpad.
And they explicitly confirmed to the market that they fully expect to grow at their target 6 to 8% clip from this new, higher baseline for 2027 and beyond.
Right. It isn't just a projection. They put their actual cash where their mouth is by rebasing the dividend 15% higher to match that EPS jump.
Exactly.
That isn't a one-time corporate bonus or a share buyback. That is a permanent structural increase in the physical cash being handed back to shareholders every single quarter.
Add to that foundational strength the incredibly favorable regulatory environment we discussed.
Texas Rule 77-102.
Right. It is a massive tailwind. It essentially removes the financial friction and the painful regulatory lag from their aggressive $4.2 billion capital expenditure plan.
Because they get to defer those costs?
Yes.
Yeah.
They're operating in a state experiencing massive, relentless population and industrial growth, and the state government is proactively providing them with the exact accounting tools necessary to build out that required infrastructure profitably and efficiently.
But, a rigorous analysis requires us to look at the bearish risks. We cannot just ignore the Waha anomaly and pretend it is a permanent feature of their business model.
The Waha spread is absolutely the biggest risk factor lurking in the footnotes of this transcript.
Because it's just surge pricing.
Exactly.
Yeah.
Capturing $4.35 spreads compared to $1.80 a year prior is a fantastic windfall, but is a windfall entirely dependent on external, highly volatile factors that Atmos cannot control.
Right. Macro weather patterns and competitor pipeline bottlenecks.
If a mild summer significantly reduces statewide power demand, or if a major competitor successfully brings a massive new takeaway pipeline online next year, those opportunistic surge pricing profits will evaporate overnight.
They will return violently to their benchmark historical norms.
They will.
Which means if an uneducated retail investor is building a growth model for Atmos based only on the explosive headline-grabbing growth of the last 6 months, they are going to be severely, perhaps painfully disappointed next year.
Because the Waha market will inevitably normalize and the surge pricing ends.
Right.
To understand the true value of the company, an analyst has to mentally strip out the Waha windfall to see the true underlying regulated growth rate.
But here's the key takeaway, isn't it? Even when you remove the Waha lottery ticket, the underlying verdict remains highly positive.
It does. The transcript paints a comprehensive picture of a utility that is perfectly positioned for the next decade.
They are geographically anchored in the hottest demographic and industrial growth market in the country.
Yes.
They have the deep engineering capability to execute massive, complex projects like Line WA.
They do.
They have the elite financial sophistication to navigate highly volatile macro equity markets by using forward sale agreements to keep their powder dry.
Very smart treasury moves.
And perhaps most importantly, they have successfully partnered with their state government to codify regulatory frameworks that aggressively protect their massive infrastructure investments.
It's like they are playing three-dimensional chess while the broader market is just playing checkers.
I love that. They are expertly taking advantage of short-term, chaotic commodity bottlenecks to pad the balance sheet, while simultaneously locking in long-term, decades-long regulatory certainty that guarantees their core dividend.
It is a brilliant balancing act.
It really is.
It serves as a textbook masterclass example of how a supposedly boring utility company can actually function as a highly dynamic, strategically complex engine for long-term wealth creation.
Which brings me to a final, slightly provocative thought I want to leave you with today as we wrap up this deep dive.
Okay, let's hear it.
As we read through the lines of this transcript, unpacking all the engineering and the accounting, one massive, unpredictable variable kept popping up: the weather.
Right, the unseasonably warm winter.
Management specifically pointed to an unseasonably warm winter altering statewide demand profiles and directly causing these wild, highly profitable price swings at the Waha hub.
It changed everything.
And as global macro climate patterns continue to shift and become more extreme, and as places like Texas see their electrical grid generation needs evolve to cope with blistering, prolonged summer heat waves and sudden, violent winter freezes, the physical flow of the natural gas market is going to become increasingly chaotic and bottlenecked.
That's a very fair point.
So my question for you to mull over is this. As these climate anomalies become more frequent, will traditional natural gas utilities like Atmos find themselves increasingly relying on these wild, opportunistic commodity spreads for their outsized quarterly gains?
Oh, that's interesting.
Will the Waha anomaly become less of a rare lottery ticket and more of a regular, highly anticipated feature of their core business model?
It completely shifts how you value them.
And if that is the case, how does a supposedly boring, slow and steady utility manage the internal corporate culture, the risk profile, and the incredibly demanding Wall Street expectations of essentially becoming an accidental commodity trader?
That is a massive paradigm shift.
It is a fascinating high-stakes tension to watch unfold over the next decade.
The fundamental definition of what it means to operate a utility is changing right before our eyes, and the data in this transcript is absolute proof of that evolution.
It really is. Thank you so much for joining us for this deep dive. We hope this exhaustive look at the numbers, the pipes, and the regulations gave you a completely new lens through which to view not just Atmos Energy, but the hidden complexities of the entire utility sector. Keep reading the footnotes, keep questioning the numbers behind the news, and we will see you next time.